When we think about the strategic challenge for global investors, of course, yields are hard to come by, both nominal and even more in the case of real yields. So when we look around the world, it seems to us there's a push, I guess, away from some of these areas with very low yields, frankly, all of developed market government bonds in that light, and towards other areas which have positive real and nominal yields. Of course, China in this regard is something like outstanding, with, by global standards, what are very high both real and nominal yields. So as part of a diversified portfolio, we continue to believe China will play an increasing role for global investors over time.
Does the Evergrande issue have the potential to roil markets, and especially fixed income markets, broadly speaking, in China, spilling over into the banks? Not getting into specifics, but broadly speaking, what do you see to be the fallout here, potential fallout here if things go wrong?
Broadly speaking, I'd say this is evidence of more progress in two specific regards. Firstly, China is moving away from the implicit guarantee and towards a more risk-based pricing of risk, market-based pricing of risk. And that's fun in the theoretical, but in the specific, it means there is going to be risk, which ultimately can mean bankruptcy and investor loss. So I think this is part of the transition, the very important transition away from the implicit guarantee and the idea that companies broadly should have the same cost of capital, because ultimately that implicit guarantee is there for everyone, away from that towards a more, as I say, markets-based, risk-based approach to how capital should be priced, which over time should lead to a more efficient market allocation, capital allocation process, which again, back on the strategic horizon, should be good news for good companies flourishing, and less good companies over time becoming a smaller and smaller part of benchmarks accordingly.